Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, August 13th, 2021. As usual, I'll start out with the broad markets, and as recently, it'll be very brief because there's really nothing new to note there technically right now. But I do definitely want to continue to provide updates on gold. Still liking gold long term. We're at the bottom of that buy zone. Or reversed off it recently towards the bottom of the buy zone. And more importantly, I want to cover the currencies, and that's again as a big part of my analysis on gold. I'll also hit on GDX from time to time. I'll cover that along with gold, and it usually goes without saying if I'm bullish on one or bearish, bullish or bearish on gold, then I'm bullish or bearish on GDX. With a few exceptions, there are times where GDX can do its own thing, but that's usually during periods of very strong selling, strong corrections in the stock market where equities get sold down and gold might benefit from a slight flight to safety bid. Other than that, the miners are simply a leverage play on gold, meaning they tend to go up more when gold's rallying and down more when gold is falling. So I'll cover those. Very brief updates on wheat, corn, soybean. Those are the grains, along with the grain ETN, JJG, cocoa, and the ETN for cocoa, which is NIB. And then I'm going to finish the video. Now, if I can get all those I just covered, gold, the commodities, and the markets in short enough time, I want to talk on junk bonds and some analysis there and what it might, so just cues to watch for the stock market. If I have to truncate the video, cut it short, then I will do the junk bonds in a follow-up video. All right, probably too much explaining, but I do that in the beginning now so you can jump forward. If you have no interest in gold or my analysis on gold or corn or whatever, you can jump forward. I'll try to stick to them in that order. So here's the markets. Again, nothing new, so we're going to move forward. I just continue. This bar gets moved every time I do the video. We had a divergent high there. We had one there. Get a little bit of a correction, but we kept going in the divergence that has been building. There it is on the RSI, and then the PPO divergence has been building from this point, and so there's nothing new. When you're at all-time highs, there's no resistance levels to cover, so there's really nothing to technically significant. The only thing I'm going to do right now, little minor trend line, horizontal support line right here. I just added 4184. I can see that reaction high there. We tried it again there. Popped it right there, broke out, and then back tested all those 60-minute candles, about a dozen of them there. So that's minor support. If and when broken, would likely take us down to the next ones. And that is all I have for you there. QQQ, kind of lagging behind recently compared to the S&P 500. We're locked in this sideways range right here now for weeks, at least the last couple weeks. And that's it. If we break out of the top of that range anytime soon, it's going to be a marginal new high, and it will still be a divergent high. Right now, that's our previous high, so there's our divergent high. And again, all we have to do is equal or slightly exceed that high, or even by a fair amount. But you can see these divergence lines would have to go all the way past parallel to be negated or taken out. So that's it. And then that's the big number that we need to break to get a party going on the downside with a correction. All right, let's move on since there's really no trade to be made right now on the markets. And we will roll into gold. I'll start out here with the daily chart. This is kind of bigger picture for longer term traders and investors. I'm going to turn off all the lines and just continue to reiterate that as of now, until we get some evidence to the contrary, gold's in a bull market, and I'm viewing this as a corrective phase within a larger bull market. And for many, many months now, even since the peak back here, I laid out a support/buy zone, which we've been in. I'm going to turn the lines back on. You can see it here. I know this chart is kind of busy, but I'll box it in. This is our buy zone. We hit the bottom of it here. So far, those have proved to be the best entries. And over a year, there was a low point in the last year or so right there. We came close here. We were still in the buy zone. So I continue to maintain what I said back here. Long-term traders, investors can scale in. That's why it's a buy zone with solid support at the bottom, moderate support at the top. And that's it. So if you're looking real closely here, so far We got about a little more than halfway down in there and reversed. And let me show you what's going on in the currencies. And let me see if I anything worth mentioning on this 60-minute chart. Yeah, there is. If you look at it this way, we had divergence at this recent low. We went up, hit that first target, and we made a marginal new low, which is still a divergent low. It's just much larger positive divergences now in the 60-minute time frame there for gold, which doesn't. There's no guarantees, but it would indicate a larger rally. This was a rally of, from that divergent low of roughly 4.5%. So one would expect, or I would expect, at least we go up now and maybe hit the second and third targets that were laid out on this 60-minute chart. If you trade futures, same thing. That was that same divergent low, positive divergence there, a little bullish falling wedge, hit my first and second target. Never broke out above the top of this range. We were bouncing in here. Mentioned this as a support buy zone for active traders with a stop below. That stop was taken out for active traders, and it cleared a lot of stops. This to me looks like some type of washout move, quite possibly, quite likely. A selling climax. So far, pretty impulsive reversal. But again, it's all about these currencies. That's what I continue to maintain. I've been looking for, and downside in the dollar, and we've had it. I'm going to do an update here. The downtrend was. Got checked with a rally. Hold on, I'm looking for there it is. Here's my chart. DX, US dollar futures. So if you recall back here, we had a beautiful, what I thought was a beautiful bearish rising wedge pattern. It broke down, back tested, and we were moving lower. And then we went on. We had a counter trend rally, which was a little stronger than usual. And this right here, I mentioned the other day, that coincided exactly with the breakdown in gold. When gold broke that support buy zone, the bottom of it, the dollar broke out. And I had warned out that the day before. I said I expected a reversal off there, but I said if you break out, then that's not just a breakout of horizontal price resistance. It's also a breakout of the downtrend line, which was well defined, and then boom. So this was a technically induced. Maybe there was some kind of move behind it, some central bank dumping gold, buying dollars, who knows. But it was certainly a technical breakout. And what it did now, it didn't change anything on this 60-minute chart. All we did is about maybe an equal or slightly higher high, and extended the same divergences that were in place at that previous high. So it has not foiled my expectation of a deeper drop in the dollar as of yet. It could and will if we go up a lot more here and we burn through these divergences. But as you can see, the same divergences we had here at that divergent high, that's supposed to be an arrow, right there, have now grown even larger, indicating to me a larger drop in the dollar, hence a rally in the euro. I'm sorry, in gold and the euro. One and the same, really. So let's talk on that, and then we'll move on. E7. Let me find that down on the bottom. You can't see it on the screen, but I'm looking for my little, in the taskbar, my E7 box. There it is. E7, Euro futures, 60-minute chart. From right here, right there, nice, beautiful, bullish falling wedge, which is, almost a mirror image of that bearish rising wedge on the dollar. We broke out, back tested, just like the dollar broke down and back tested its bearish rising wedge at the same time, and rallied up, hit this level, and this is where we were that day right here. Before gold broke down, the euro had the secondary trend line and resistance at 11.119.15, but instead of breaking out as I expected at the time, it got rejected. But again, expectation is not a breakout, so we never had the breakout. It basically was just a failure at resistance, and all the euro did at that point is go on to put in an even larger divergent low, made a slightly lower low, marginal new low, reversing so far. So now this is your line right here. That's the level to watch. In other words, let me strip all these colored lines off and show you the bigger picture. There's the downtrend line, there's the divergence, like that just forms a bigger wedge. So when we break there, we already checked 119.15 a couple times, so we may get another reaction, maybe not, but I still expect a run up here to that target zone, 119, that's 1994 to 2023, and then I have another potential target resistance up here about 121 or so in the euro. Okay, so that's all near-term stuff, active trader stuff, but then bigger picture, for those, whether you're trading the euro, the dollar, gold, silver, GDX, any or all of the above, is this euro US dollar chart. That's what you can see here. That's the euro US dollar pair. And back here we had that this line was our primary downtrend line, still is. We put a divergent low there, took out a minor trend line, had a big rally up to it, pulled back, another divergent low, hit it, pulled back again, finally broke out. So this was, I mentioned at the time, a major breakout of a primary downtrend line. But what happened is, we zoom in nice and tight, you don't go up forever. You broke out, and then you put in this wedge, mentioned at the time as well, with negative divergence right there, and we broke the wedge. And I said if we did, targets would be 119,360, which was hit, and or a back test of the trend line, which was hit. So that's it. So bigger picture now. Again, weekly chart, big picture, breakout, successful back test so far, successful back test of the trend line, rallied up again, hit this 122,617 level again. Maybe we come in a back test it, maybe not. I'll show you why the maybe not. But ideally, we've already back tested once. The ideal scenario would see a reversal here and go on and break that level and then take us up to the next target. And remember, gold moves almost in lockstep with this chart. This is the euro plotted against the dollar. And so gold moves up when the dollar goes down, and the euro goes up when the dollar goes down as well. Daily. Okay, so why might that be it? Well, let's see. This is a daily chart. You can see all these, divergences. Positive divergence, big low right there, and led to this rally here. We had a little rising wedge with negative divergence right there, correction. Positive divergence, rally up to this divergent high, and we've corrected since then. However, here's where we're at today. We have this little wedge, which also was seen on the 60-minute chart, the one I just showed you on the 60-minute chart, that broke out, and then we put in that marginal new low like that. So, remember, we're on a daily, but these are the same, same price action. There's that additional marginal new low, extended the divergence, made it even bigger, and at the same time hit a beautiful support level, that 117, 115 level, that previous reaction low. And not just that, but these are big. Traders always look for major reaction lows like that, the pivot points they call them. And then you have a lot of reactions in there as well. If it gets taken out, let's just say we break that level, well, there's big support down here at about 116. 116.045. That would be, near-term bearish, longer-term bullish if we reverse from there. However, it would be ideal to see the euro hold this level and then go on to break that trend line right there, and you can see the potential targets above. So again, bullish for gold if that happens. This could be near-term bearish if we broke that, but then reversed in longer-term bullish for gold. As of now, I'm leaning towards this. The breakout that we continue up from here, and that's the end of the correction right here with that divergent low. Okay, so trade the euro, dollar if you want, trade gold, trade silver. Silver will tend to move with gold, or trade GDX. GDX, a gold mining ETF. Beautiful support here. It's been mentioned many times about the 31.33 level. This coincided with those multi-year lows in gold, those two tags of the bottom of my support zone, buy zone. In the same time it was mentioned there, you can buy GDX as well. GDX off that level was good for a rally of about 27, almost 28% from that support level. And what it did from there, it took out this downtrend line right here. It took it out, back tested it, and we're just back testing again. And we're also we came very close. Remember, the first time we slightly undercut that support level. Second time we reversed a little bit above it. This time we reversed a little bit more above it. So if we can go up and take out this reaction high here, you have pretty much the makings of a near-term uptrend. Higher higher lows, but we still have to go on and take out these previous reaction lows. So all I'm trying to say here is this is still an objective buy zone for long-term investors, traders, gold. 60-minute charts, well, I just showed you those. You can make a case also now as a swing trader, especially if those overhead resistance levels that are coming up are taken out. So that is pretty comprehensive overview of gold and the dollar and GDX. All right, let's move on and wrap this video. Oh, you know what? I still have to do the grains. So let's start here with wheat. I'll start with the futures, then we'll look at the ETNs. ZW are your wheat futures, which are right here. And that's it. Most recently, we had this little wedge pattern that broke down. And I said, we broke down, there was support there. I said, ideally if we held that, but I said, look, commodities are in a bull market. And it's not unusual to see a little brief dip below. That would clear some stops, shake out some weak handed longs, suck in shorts, and that's what happened. So we only dipped slightly below. This was a breakout right here, as I mentioned, above that 716, 654 right there. We came in and basically back tested it, slightly below it, and then look at that. The buyer stepped in. They pretty much foiled this bearish rising wedge. That is indicative of bull market action, not bear market action. Bear market action, you get a little 60-minute wedge, usually is the catalyst for the next leg down that takes out the previous lows. That's what it looks like on the 60-minute chart. And if you trade ETNs instead, then you have WEAT. And if you buy here, have been buying at this trend line, it's a gift that just keeps on giving. That's the uptrend line for the bull market in wheat. Last opportunity was right there when it pulled back to the trend line, and now we've gone on and we've just slightly taken out, not by a large margin, but taken out that previous high. So this puts it a new multi-year high. Here's some divergence. Now I pointed out we've seen divergence in some of these commodities recently, and most of the time they played out, but not for anything much more than just a corrective phase within the ongoing bull market. It is worth noting that this high is a divergent high, and it could bring us back to the trend line. I mean, anything's possible. It could break the trend line, but if you're in a bull market, if you get another opportunity to buy at the trend line, you do. You step in and buy with a stop somewhat below, unless the charts are screaming not to. There's some support right about here if we pull back as well. So these are your potential buy points. And again, this is a breakout to new highs. Wouldn't chase it here because your buy point on the 60-minute charts I just showed you on wheat was just recently, a week or two ago. And then the other one I said at the time, we've had quite a few trades on wheat and corn, but I said the other day I like corn a little better. At this point in time, I thought it might have a little less downside risk, and it didn't. It didn't go down as much. Where wheat had come back and failed the breakout by a little bit, corn remained in this trading range here and never dipped down below it. And then I had mentioned the next, buy signal or breakout would come on a break above 558.052, and that's what happened. I updated this one yesterday. We were right here, and so you could take profits there. If you did, there was a little pullback. Oh no, wait, I'm sorry, it shot up. I said that would be the next target as well, 595.462. So we shot up and we hit that. Now, bigger picture, we're still in this trading range here. So I'm not screamingly bullish. In other words, this was a swing trade, and the max target I laid out was hit. So technically, you should be out if you were just swing trading. But again, a longer-term trader, you flip over to daily and weekly charts, and then you decide to ride out the pullbacks if that's your plan. This is what it looks like on corn. Our primary uptrend line, CORN, is the ETN. We kind of need to take out this a little triangle type pattern there. Obviously need to take that out, and then 2270 is pretty much these roughly 2270, these two reaction highs. Break to the upside would be bullish, and again, as long as we remain up above this uptrend line, we are clearly in a bull market in corn. If we break the uptrend line, does it mean the bull market's over? No, it just may mean a deeper correction. Could mean that, but at this point we have solid support about 1917. If it breaks, that might hold, and if that goes, we have very good support around 1744, and that could still, and it would still very much keep this in a bull market, bull trend if we went that low and reversed. So because you have a reaction low there, it would just change our trend line like this, and so that's it. So at this point in time, and for the last few months, I talked about it back here that commodities really had a hell of a run off the lows in the last year or two, depending on which commodity it is. And there were quite a few divergences and overbought conditions, and I warned of maybe some consolidation correction. That's what's happened. So it's more of a, active traders can do these hit and run trades based on the 60-minute charts. Long-term traders, you're just going to have to be patient. Who knows? Nobody can say how much longer they might need to consolidate. But what you can say, if they break out, you start seeing these individual commodities break out, then that could be the catalyst for the next leg up. The other one I mentioned the other day, well, no, while I'm still here, let me not jump over to cocoa yet. Let me hit on soybeans because that's another one of the grains. SOYB. There's the uptrend line. That was broken. See, that one had a divergent high, and here was a correction in a bull market. I believe it was outlined at the time. And we broke the trend line, and look, there it is. Right below the trend line was big support, just like what I showed you on corn and wheat a minute ago, if those trend lines do break. And so we broke it, and the drop wasn't that much. It was enough if you wanted to sidestep and get out and avert that almost 9% drop since the trend line broke, but you hit very good support right there, 2150, and bounced, back tested the trend line, moving around, but then we've been holding this other support here, 2273, see that? And if we can pop this downtrend line, then that's going to be bullish and probably go on and take out the previous highs. So here's again a big divergent high following a much bigger divergent low. This was the end of the bear market in soybeans. Say what you want about where you think commodities are going, where inflation's going. You can't argue that this is not a new bull market because we've taken out all the previous highs. And that's definitely a bull trend right there. And so there it is. It may continue. And again, commodities, there's just a lot more upside. If you go back to where a lot of these commodities were, 4, 5, 6, 10 years ago, they've been in a vicious bear market. So I continue to maintain there's just much better valuations and upside, the better risk reward profiles, less downside risk, even if they correct and go down for a while, and more upside potential, I believe, than the stock market at this point in time. Okay, and if I'm talking so fast your head is spinning, do I buy corn, do I buy wheat, do I buy soybeans? Well, you can, one size fits all right here. I've talked about a lot is JJG. It has all three. It's the grain ETN, and that's it. It has corn, soybeans, and wheat. And there's a downtrend line right there, which was just broken recently, so that gives you a near-term buy signal. And if it can take out each of these reaction highs, each one is bullish. That will increase the odds you're going to continue up and probably take out that previous high. Again, like everything else, I put in a divergent high right here recently, and they've had a correction. They corrected back to right where it should have. This ETN came right back to that 60.39. That was, see this trading range? It was the top of that range. Should it have another leg down and comes to 57.38? That would also be an objective buy point. If it breaks that, not good, because I don't have support all the way down to 56. But either way, we already broke out above the downtrend line, so I'm favoring more upside here. And cocoa, I just mentioned the other day as well. Beautiful. Look at this, just a beautiful uptrend line, providing many ops to go long. On pullbacks to that trend line with stops below. That's what technical analysis is all about. And recently, let me see, I have two boards here. Well, yeah, this is the board. Recently, we just took out this level right here. We zoom in nice and tight. We had a support there. Went through it, but we also had enough reactions to make that line valid, and we broke above it, and it's been moving up. So, and it also had nice positive divergences right here at the recent lows when it came and tested that trend line. So that's NIB. You can also trade that via futures, and the futures broke out above that resistance level there and continue to move up. So that is cocoa, CC, or the cocoa futures. Okay, I'll tell you what, we're a little over 23 minutes into this, and I'm talking fast, so I'll go ahead and cover the what I wanted to show you with corporate bonds. Corporate bonds, the low grade, aka junk bonds. And here's an article. I'll link to this article. Articles are a dime a dozen. You read one, and somebody's going to make just a bang-up case for why this bull market or the bond market has a lot more room to go, and the next guy or gal makes the opposite side of it. Here's an opinion piece just about what's going on in the economy and how incredible this run has been. But this guy talks about this paradox, and I've seen it, and you've probably seen it. For over a year now, restaurants, hotels, other service sector businesses have either had to shut their doors, I should say, or drastically reduce revenues due to rolling lockdowns. But yet when we pass by, say a large hotel chain, the lights are on. What's going on here? This is, have these businesses discovered a way to turn lead into gold? Where's the money coming from? He goes on to say, and again, this is kind of well known if you're into this stuff. What's kept these companies afloat, besides massive government bailouts, are bond issuances. They're junk bonds. The junk bond is the lowest. When you're below investment grade, junk bonds carry a much higher risk of defaulting, meaning you're going to get a higher interest rate if you buy a junk bond or a junk bond fund, but there's a much elevated chance that if, let's say, you buy a junk bond fund, that a good percentage of those bonds may default. Now, everything ebbs and flows in the markets, and right now default rates are low, again, for two reasons. Number one, not just the government bailouts. If you own a restaurant or a hotel or an airline, guess what? You got massive amounts of money free from the government just to keep people on payroll, to keep the lights on and all that. So that in itself helped. But more so the fact these companies, that wasn't enough to keep a lot of these companies open. It was the fact that they could issue and they could access the junk bond market. And I've talked about this before. Some of you probably read or heard about this, but when COVID hit, the Fed did an unprecedented thing. They evoked emergency charters. They're part of their charters normally not to buy bonds, junk bonds. Treasury bonds, yes, but not corporate bonds. And they actually evoked emergency charters that allowed them to go in, and they directly intervened with the bond in the bond markets, buying junk bonds and near junk rated bonds, and to backstop that market. You probably remember, we shorted LQD several times, made two successful trades. The third one, that's when the Fed stepped in and announced those programs. They blew it out. And now what happened then, and I talked about at the time, is it completely and utterly destroyed the mechanism of price discovery. If you Google that term, you'll see price discovery is just the natural market forces that determine a price on a security, the forces between buyers and sellers. And that's what price discovery is. That's where the markets normally are very efficient in determining what an asset should be worth, a stock, a bond, a REIT, commodity, based on those forces. And when you have unprecedented market intervention, I mean, there's no comparison in history to what the Fed did and has continued to do now. They didn't, and I haven't read much up on it recently. I remember at the time they were authorized to buy a lot more than they did, but it was just the announcement that they were backstopping this market. It blew the shorts out. There's not a short on Wall Street, not a hedge fund or professional that would take the other side of a trade against the Fed. When AMC, when the apes, they call themselves, those Reddit crowd, they actually blew up at least two hedge funds by going in and going against their trade. They were short, and they can do that. Why? Because a hedge fund is as powerful as they are with some of these with billions of dollars or many millions. They do not have unlimited resources, unlimited funds. They have a finite, limited amount of funds. They have risk controls, so they were blown up. They are subject to margin calls. The Fed isn't. The Fed, and if the Fed needed more to backstop, they would have just gone in and got that authorization one way or another. So, okay, where am I going with this is, I told you guys I stopped for a while, and it's been a while. I pretty much stopped charting the bond market. And, that article goes on to talk about primarily the junk bond market and how, it's just a matter of time because these companies do not have the cash flow. They do not have the fundamentals. It's kind of like a Ponzi scheme, if you will. They're issuing debt because they can, because this market is so high. They can issue junk debt, sell bonds at extremely low rates, and they're artificially low rates. They do not factor in the risk that these companies face in the potential for bankruptcy, or and those bonds going to zero or defaulting, I should say. Again, from due to the Fed backstop. However, what I've done, since you can't really trust the charts, all we know is the Fed will be exiting that market, selling off their bond holdings, both treasuries and corporates, and at some point, they won't have the the power to just come in at will and and modify or come in and backstop the bond market, unless again we have another major financial crisis. Okay, so where am I going with all this? JNK and HYG are the two biggest ones, I believe, if not the two biggest junk bond ETFs. And although they're at resistance, and they have had for a while, negative divergence continues to build. There is that on the technical case, but again, they've gone kind of sideways. They're at multi-year highs. You can see they all both fell off a cliff during the last recession. You roll back in time, and you see the same thing back in. Go back here. In the last financial crisis, this is what happens. These things you can get wiped out in short order because when the economy turns quickly, default rates spike, meaning they stop paying interest and principal on a good percentage of those bonds, so the prices really fall hard. Okay, so where am I going? Well, okay, we can't really trust the charts per se on the bonds with the market being backstopped, or at least the implied fears that the hedge funds and those that are savvy enough to short bonds might normally do so. So what I did is I pulled up a list of the holdings, the top holdings that these two bond funds have. And that's easy to do. You just Google search, JNK ETF, go to holdings, and they'll give you these ETFs. Like just about all ETFs will give you a list of their top holdings. So I'm not going to track, hundreds of holdings. I only have to look at the top 10 or so, and that's what I did in here for both JNK and LQD or HGY, excuse me, HGY right here. There's their holdings, and I put them into a watch list. And here's that watch list. All right, so what I'm going to do, and then we'll wrap the video. It won't be much longer. I just wanted to give you my explanation. It's kind of a go-around method, and I've done this before. If there are distortions, since we can't really trust the charts so much of junk bonds, what I'm going to be doing is keeping an eye on the company's stock. Because the Fed isn't buying their stock, they're buying their bonds. That's supporting that market, which is keeping those companies afloat, giving them the liquidity they need to pay the bills, whether or not they have the earnings to back it. They have the cash flow, and so I'm just going to rifle through these very quickly and just show you where they're at from a technical perspective, and I'll comment on each and every one. So bottom line is, if I start to see the vast majority of these top holdings breaking down, especially coming down pretty hard very fast, that will give me a kind of a heads up. Hey, something's rotten in the state of Denmark, or something's rotten in the high yield market if their stocks are plummeting, because that will happen. So we're going to look at this one first. BHC, Bosch Health Companies, again one of the top holdings, right on trendline support plus price support. So pretty much a break below the trend line, and then again on 24.67 would take this one down lower. As of now, it's above trend, so I can't give you a sell signal on this one. It did put in a divergent high in this wedge back here, and it has been moving since. So it is in a intermediate term downtrend within a longer term uptrend. If it breaks this trend line and it breaks that support level, that's going to call that uptrend into question, and then I would give it a sell signal. So as of now, one to watch. HCA next, beautiful uptrend line. So what I'll do after this video is I'm going to go through here and set price alerts on all those levels, so I don't have to watch these on a day-to-day basis, although I probably will check them, just look how they're doing. But if all of a sudden I start to get price alerts going off like popcorn, one after another, these guys are breaking down, then it tells me there's something wrong. These companies have a problem, and that is going to affect those junk bond funds, and that's one pillar of the markets. A lot of professional traders will watch that. You look at what junk bonds are paying versus what treasuries are paying. That's called the credit spreads. The difference between safe government debt and high yield debt, and when credit spreads widen, and I've done this many times over the years, pointed out those spreads. That is often a early sign or a red flag, especially when the stock market is still rising, and then all of a sudden credit spreads start to widen. That often precedes corrections or even bear markets. All right, so HCA fine for now. They're just gapped up the other day, so there's a big old gap, This is where I'd get my check mark for a short or trouble, a sell signal to break down and take out both the gap and that trend line. So anything down here, as of now, it's above trend. Overbought, but that's about it. Overbought's not a reason to short or sell. Again, one to watch. T-Mobile, TMUS. This one broke down recently, although it's not really moving down impulsively, but it is below trend. So that is a sell signal. We'll call it for what it is. So there's a check mark on a sell signal. The sector is holding up, but if you start to see this one move down, my next support or first target is 135.18, give or take. Break of that. Each as and if each of these support levels broke, and you get additional check marks and more red flags for, again, the junk bond market. And I think you can see the targets. That target down there, which I think will be hit, is about 107.86. CNC, Centene Corp, right on a primary uptrend line. This trend line comes off the 2016 lows. This was a waterfall sell-off, brief spike. That was during COVID. Perfectly normal to allow a little violation, like a quick move down below of the trend line. Other than that, there's a lot of reactions on this trend line to help validate it, and that's it. And we put in a divergent high, just like we put in a divergent high here. Last time we put in a divergent high of this magnitude, the stock fell. I'll have to put my line there and stop a little below. We fell about 45%, so we got chopped almost in half. That's a big trend line, even longer than that one there. It comes off the same point. It just doesn't have the same slope. So there it is. This one's on the verge of a sell signal, but as I like to say, support is support unless broken. Could certainly do this. And if it does, I'll just be on the lookout later on for a breakdown. If it breaks down now, then I'll be on the lookout for the other companies. If just one of these companies breaks down, and again, I'm looking at their stocks, but that's a good sign. If the stocks are moving lower, it wouldn't make any sense for the valuation of those bonds to be increasing. They're going to go down. I mean, something's wrong with the company. THC, Tenet Healthcare, again, just another, and this is why I'm doing this video, and this is why I'm going through these components. Not all of them have these clean trend lines or support levels, but a lot of them do, and a lot of them are right there. In fact, this one just broke down recently. Another one, it broke down, back testing. It's not a very impulsive breakdown, but it is a breakdown. So I'm going to give this one a check mark for a sell signal as well. And I have little notes here. See weekly chart. You want to look at the PPO on this one, the histogram. And what I've done here is noted, that's how I like to use the PPO histogram. When I see these, what I call hills, these clean hills on the histogram, that's when the PPO line is above the signal line. It means the trend's bullish. And this is a bearish cross. When the lines cross, these lines right here, then the histogram goes red. And you can see it does a great job of ending when this happens. And I didn't go all back this far. You can see all my lines. Let me just show you. If you can't see them in the video, I have those lines right there. These are when the PPO crossovers occurred. Hopefully you can make them out so I can save time and not have to do each one. And each and every time it was followed by a correction. Now it doesn't look like much. I'm going back a decade or more here. But these are all well into the double digits. That's probably a 40% drop. Then we got the PPO crossover right there. Again, the histogram went from that green hill down to red hill down below. And before all said and done, the stock fell 78%. Almost 80% of the market cap was wiped out. There were bear market rallies along the way, and the hill went green. But then again, you got another red sign there. So I think you can see where they are. These are all the corrections. These are all the crossovers right here, here. Again, a pretty dang accurate predictor. You go back in time, there's an occasional whipsaw here and there. Study this yourself. Replicate this. Again, we're on a weekly time frame, and you can see we had a crossover here. And it proved to be a whipsaw because we went green just a little bit right here. You can see these green bars flattened out, but now we're back red again. So, and we're also below the uptrend line. So this one on the weekly, I put on a sell signal as well. And again, one of the top holdings of the junk bond ETFs. All right, we'll rifle through the rest, and I'm going to wrap this video up. TDG is right on trend line support, and I'm looking. Okay, there it is. I wanted to cover this. Yeah, let me have to turn up the lines for you to see. What I have are the 200-day simple moving average in blue and the exponential 200-day moving average in red. I'm going to turn those lines up, and they do a great job on a lot of securities. Not all. I have to look at each security differently, but they do a great job of acting as support during an uptrend. You can probably see it right here. Support, support, support. Support. You had a few brief whipsaws. We snap back each and every time. Support, support. And this was a solid break below both again, the green and blue lines. We broke below the 200s. Bottom fell out of the stock. We recovered them right here. There's the 200 simple was recovered. The 200 exponential was recovered. Here, I'll zoom in. You can see we back tested them once we recovered. We back tested successfully. Here's this 200 simple coming, or the blue is the simple, the red's the exponential. Both came in together, perfect back testing for a couple months, and then boom, off to the races. Pulled back, hit the 200-day exponential moving average. The buyer stepped in. Hit both right here. Right now, they all come in together. I have a trend line, an uptrend line that's nice and clean. I have the 200-day exponential and simple both under that trend line. So I have three, not one, but three well-defined support levels, and this one's testing all three of them right now. It hit them all three right here recently, bounced, but we're back again, and that's also a sign of weakness when you hit and you don't walk away and start the next uptrend. When you're already back to it again, anyways, it's not a sell signal yet because we're above all three. We're at support. If anything, you go long right now. That's the only play there is on this stock because you're going long at support with a stop below. But if you don't believe it's going to go up much, as a sell side or a short trader, you just want to wait for a solid break below those. And again, if one goes, all three of them go. All right, I'll go through the rest a little faster. CCL, trendline support right here. We already put in a divergent high right there. That's Carnival Cruise Lines, by the way. Since the divergent high, we've been correcting. Big support right here. We just hit 1932 plus uptrend line support. We have a now third reaction. 1, 2, 3. So there's some support, trendline support and 1932. I think you can see just above there, there's a confluence of all three of the moving averages on this chart. I mentioned the 200-day simple and exponential. I also have on the yellow line the 50-day exponential moving average. And right now, all three are above as acting as resistance or potential resistance on that stock. So it's in a precarious technical posture. It's in a near-term downtrend, but big support below. If that breaks, it's not going to be pretty. And keep in mind, a lot of these companies, I didn't mention this, but are certainly going to or have the potential to be impacted by what this new Delta variant does with COVID, such as Carnival. It's going to make or break it. Ford, I've covered Ford recently. Big, well-defined uptrend line starting to crack, but the stock hasn't gone down much because there's solid, pretty decent support, I should say, at 1350-ish right there. And so if it breaks it, I see nothing less than a drop down to the 1120 area for Ford. If it breaks 1350 with conviction, and that would be a drop of about 17%, and that's going to put pressure on those high-yield bonds. AAL, another one that's COVID sensitive, we'll call it. Put in a divergent high like a lot of the airlines, ran into resistance, been walking down, but it's at, or just recently hit support about 1873. CZR, Caesars Entertainment, put in a divergent high right here. That's negative divergence, and it's been walking lower lately. Pinched right now with the 200-day moving averages just below and the 50-day just above. So if it breaks the 200s, 68.44 is going to be your first target, then 43.82. So no check mark there. Well, depends how you look at it. Let's just wait for those 200s to go. CCO, Clear Channel Outdoor Holdings, broke its primary trend line recently. That put on a sell signal. But like so many others, because we're in a bull trend, there's a lot of support levels below current prices, and they need to be taken out. So in this one, it's 223. We already hit it several times. A break of 223 will likely take this stock down. I'm going to move that line up a little bit for you right now. I'll take you down to about 175 or so. OXY, Occidental Petroleum, dancing on support. Put a big divergent high in right here recently. put a divergent high in there, and it corrected and went on, made an almost equal, slightly higher high, extended the negative divergence. Just like the positive divergence down here and the trendline breakout was the catalyst for this whole move up. We've come full circle. Now we put in negative divergence, and we're probably going to head down, especially with if that pairs up with my outlook, which it does, pairs up with my outlook for crude oil, and that would be a drop of about, if we hit that 1717 target, drop of about 35% in Oxy. CYH, Community Health Systems, sell signal triggered, so check mark there. There was our uptrend line, big rising wedge, negative divergence, and sell signal breakdown coming up on the first target 1128, then 906, 785, and ultimately I think this one probably work its way down to this longer term uptrend line. And that takes it. I think that's it. Yep, that's all of them. All right, guys, long video right at the 45-minute mark, but that kind of gives you an update on gold, some commodities, and this junk bond market, which I'll continue to watch. And I'll continue to also watch the credit spreads, maybe get a chart out to you on that. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.